today. So if you missed anything or anyone, maybe one of your colleagues wanted to attend the session and couldn't, we'll definitely send out the recording of the session as well as the PowerPoint slides and as well a copy of the COVID-19 impact study that Frandata did for IFA. So you'll be getting all those materials sent to you after the call. As I said before, my name is Paul Santamaro. I'm Director of Lending and Risk Products at Frandata. And today we're going to take a look at the COVID-19 study that Frandata just presented to the IFA. And we're going to look at the impacts of that study and some opportunities that are available and emerging right now for lenders in the franchise space. We're going to start by just taking a look at the numbers of the study in IFA. There were some really interesting kind of whole national numbers about the performance of franchise units, as well as some insights to specific sectors and industries that are performing. Some are performing better than others. We're going to look at what are the key takeaways from those numbers and what are the implications to franchise lending in different sectors and as well as the industry as a whole. We're going to take a look at some case examples of specific brands along the way to kind of talk about how they're affected by COVID and how they have been mitigating the potential impact, as well as what we're seeing and hearing from other franchisors in the industry. Then we're going to look at specifically where are the opportunities for lenders and what's happening in that space. And then we're going to look at specific business development strategies. We're going to look at what we call top-down versus bottom-up, and what that means in terms of reaching franchisors or franchisees and new business in the space as well. So we're going to be taking questions throughout the presentation. There's a Q&A box, I think, with the interface there, and someone from our marketing team named Melinda is going to be on, just kind of collecting those questions, making me aware of those. So if it's topical, we might stop in the middle of the presentation, but we'll certainly take time at the end to look at any of the QA that you guys might have from today. So as I said, Frandata just presented a 6-month kind of look back on the crisis starting from March to today and what was the impact of COVID-19 to the franchise industry, and recently presented the information to IFA. Taking a very high level look at some of the impact numbers on this. The actual report itself, like I said, it'll be sent out to you and is available. So we looked at how IFA impacted the franchise industry in terms of business closures and operations in certain industries. We estimated about 33,000 businesses were closed as of August 2020, and of those businesses, about a third of those, about almost 11,000, are expected to be closed permanently. So the situation is quite dire in the franchise industry. We looked at some information from the Census Bureau as well, and they projected that in the next 6 months, about 1 in 20 small businesses would permanently close above the numbers that we're already seeing now, which would put another 36,000 franchise businesses based on those numbers at potential risk. There were some bright spots, though, in certain pockets of franchising. We're going to talk about exactly where those were and what those mean. 26% of franchises have actually regained their normal level of operations or were just kind of minimally affected by COVID as of the beginning of September. And if you're looking at franchise businesses as a whole, if you're trying to understand, what's the impact to my portfolio and, how a franchise business has taken a hit, on the whole, on a par unit basis, on average, franchise units are experiencing about a 20% decline in revenue in the current period versus where they were during COVID or before COVID. From a sector and industry perspective, the greatest impact was felt in the hospitality and the restaurant industries, as is probably expected, followed by personal services and retail. We're going to take a look at exactly what that means and what types of brands are included in those sectors. Now, as you may know as well, unit location had a big impact, very much a regional story in terms of where the greatest impact were to franchise businesses as a whole. The most negatively impacted industries were in the Northeast and the West Coast, so think New York, New Jersey, California, Washington State, and those regions. And the states that encountered the least impact for COVID were in the Midwest regions, Idaho, Utah. We're going to look at some of those numbers here in a few slides. From a support perspective, from a PPP and EIDL loan perspective, we spent quite a bit of time with the PPP loan data and kind of ripped it up and tore it apart in service of the IFA to look at what was the impact and the amount of loans that were received by franchise businesses in the support program. About 70% of franchise businesses across the U.S. received a PPP loan, and about 20% of them received EIDL loans as well during the crisis. So very much the franchise businesses and franchisees were very much taking advantage of the support programs that were available. And in the outlook going forward, we expect franchise businesses to outperform independently owned and operated local businesses, just from the sheer fact of all the different support structures that franchise brands inherently have for their franchisees, right? So, benefits and resources from the brand themselves, and also received benefits that are being received from the community of franchisees within that system. And one of the case examples we're going to take a look at a brand called School of Rock. And one of the things they did was to enhance their communication between franchisees and executive management. Talk a little bit more about what that exactly meant. But so franchise businesses and franchisees have that inherent support structure of the system that should make them weather the storm and potential impacts to COVID a little bit better than the rest over the next 6 months. So I promised to look at the sector and industry, and I wanted to just throw some numbers up there just so we can take a look at what the size of the universe was and try to look at where the permanent closures were within these industries and to see where some industries were more affected than others. We talked about hospitality and restaurants. Hospitality only has about a tenth of the units of the restaurant space, but they still had a very large closure rate at about 2%. Restaurants were affected. We're going to look at personal services. Now, commercial and residential services, as we'll see, were not as greatly affected. So these are some of the numbers that are coming out of the report, and that information, as I said, is available to you in a more longer form in the report that we presented to the IFA. But I want to focus more on kind of what the impact of these numbers were, what we're seeing, and how has that actually affected these specific industries. So in hospitality and restaurants, as you guys know, the last 6 months have really, really been challenging for the hospitality and the restaurant space. 40% of the businesses in that space are still suffering revenue losses. In the next 6 months, we're expecting about half of those businesses are going to require additional financial assistance or capital. And whether that's going to come from another round of PPP funding, whether that's from existing relationships that they may have with banks or new ones that they're seeking, there's still going to be a lot of capital infusion that's needed in these businesses in this sector over the next 6 months. 11% of the businesses that we surveyed and looked at actually anticipate a permanent closure of their location. So there's still more closures to come, we think, in the hospitality and the restaurant space. In terms of the temporary versus permanent closures, as we saw on the previous screen, about 591 of the total 2,100 are going to stay permanent. So hospitality is still having major impact. What we've been seeing from the franchisors in that space is that if their units are performing, if they are still open, they're typically located around the coast, they're around destination areas, resort areas, beaches and those types of things. The inland units are really, really suffering, mostly because of a complete halt in most business travel. And I know I haven't been on the road in many, many months. That's affecting greatly the hospitality industry, especially in the interior of the United States. Moving to the restaurant industry, they experienced the highest number of closed franchise units, with 14,000 businesses were closed. And we think about 10% of those 10,000 of those restaurants were temporary closures, while 4,100 are going to be permanent. So there's a lot of job loss, a lot of revenue loss in the hospitality and specifically in the restaurant industry. So given this and knowing what we're seeing in the food space and in the hospitality space, how do we think about the food space going forward? What are the types of concepts we should be looking at, and how should we be thinking about food when we're talking about the context of franchise credit and lending to these concepts? Really, it's all about the business model. That's what you want to focus on. Is it a sit-down restaurant, which is a traditional food service kind of sit-down experience, or is it fast casual or QSR? You hear these terms thrown around a lot. You hear fast casual, you hear QSR. For Fran Data, fast casual is more of a marketing term. We track fast casual concepts inside of QSR, and we report out separately on the QSR segment. So when we're thinking about business models, we're thinking about QSR versus sit-down restaurants. What's the type of the model that the franchise is putting out in terms of their locations? Is it an end cap location? Is it in line? Is it a freestanding location? Can it accommodate drive-through and some of these other factors that we're going to talk about that have helped brands weather the crisis? Talk about their footprint and how much square footage is needed for the unit itself. And is the system, the franchise system, exploring low footprint models? That's another aspect of brands that were successful. Brands that already had a low footprint model were doing really well as we're seeing a lot of franchise brands kind of rolling out new concepts, new low footprint models to respond to COVID, again, trying to shift their business model to better manage the crisis in the current environment that we're seeing. And one of the things we look at is revenue per square foot. So when we're looking at top line income for on the unit level for a franchise, we'll also look at the square footage and say, okay, what's the revenue per square foot? And some of the high performers we've been seeing inherently had a high revenue per square foot kind of built into their business model. How they serve the customer, right? So how do they actually interact with the customer? And is the business model set up for carry out and delivery? As you're going to see in the example slide coming up next, drive-through is nice to have, but are there other ways that the brand might be aligned for mobile ordering, for carry out, for delivery, these types of things? How do they serve and interact with the customer? Important to think about when you start to think about what are the types of concepts and business models that are going to be resistant to COVID and are going to succeed and excel in the next 6 to 18 months. So where are the bright spots? Where have we seen? We talked about some of the types of concepts and characteristics of brands that would be successful. What are the bright spots that we're seeing? Around drive-through, this is one of the things that I talk to lenders a lot about. It's the first thing that comes to mind, right? Well, okay, if they have a drive-through, they're in great shape. Drive-through certainly has an impact, specifically within systems. If you have a system that has drive-through as a potential option for one of the models, the units that did not have a drive-through as part of those models were severely handicapped. Dunkin' specifically, the Dunkin' units out there that had drive-through, and by this point most of them do, greatly outperformed Dunkin' units in lender portfolios that did not have drive-through as an option. So within a specific system, we found that having the drive-through was a really big impact for success. But in this next example, drive-through alone doesn't just determine who the winners are. Just because you don't have drive-through as part of your model didn't mean that you weren't able to be successful during this time. Think about concepts like Jimmy John's and Firehouse Subs. They actually did really well without drive-through as part of their business model. And if you think about how they do business, their models already feature these accessible inline locations most of the time with parking spots in front. So they're already leveraging mobile ordering, pickup and delivery. With that accessible parking, they were very easily able to implement pickup services like Uber Eats and Postmates and that type of thing. So these franchises were already kind of set up to do mobile carryout and delivery, and then just went ahead and enhanced those lines of business and those pipelines as the crisis unfolded. We hinted a little bit about the small footprint model and this idea of a kiosk model. And where we saw bright spots in food were in brands like Scooter's Coffee and PJ's Coffee. These are concepts that you guys may have heard of. They have a coffee kiosk model, which was not affected by social distancing measures. And what we heard from some of the franchisors is that they actually benefited in a lot of cases from some of these large national chains being closed, like Starbucks. That was specifically the case with Scooter's Coffee. With PJ's Coffee, they have evolved a new model. So Scooters was already offering coffee kiosk. PJ is now rolling out a low footprint kiosk model to go with some of their other offerings to again respond to this change in COVID in the environment and the way that businesses are doing business in the food space, and they're seeing a lot of success and interest in that model. So that's something to look at from franchisors. One of the things I don't think I'm mentioning in any of these slides as well, but is going to play a role going forward, is as these franchisors start to come up with new models and new concepts, we are paying very much close attention to how those two different models are going to be administered from a franchisor perspective, right? So think of the legacy model that's going to come, and then the new kind of COVID model. And just looking at PJ's Coffee, they're going to start offering a coffee kiosk model. How are the differences between those two models going to be administered by the system, and is one going to have a greater focus than another? Where are your franchisee borrowers in that system? Are they on the legacy model of this franchise, or are they signing up for the new and improved kind of COVID model? That's something to pay attention to when we talk about franchise business models and how they're going to be changing and adapting with respect to COVID. Finishing up that point, is the brand just being forced to adapt because of the new changes in how we're actually serving and interacting with customers? Think of a brand like Golden Corral. That's a buffet restaurant, or the Melting Pot, which is a fondue restaurant, right? It's a sit-down fondue. That's very, very challenging to execute in the new environment. We know specifically that Golden Corral has been experimenting with different things, waiter-served buffet, other ways to interact with the customer. But they have a major, major challenge ahead of themselves in the buffet space. So again, how are these brands adapting? How are they changing their models to be able to adapt and deal with the challenges that are in front of them right now? Personal services, and we looked at personal services, this has a wide range of business models. So when we look at the franchise industry, there are concepts in all these different areas, from education, health and fitness, recreation, beauty salons and hair care. All this falls under personal services. A lot of the franchisors that we talked to saw either partial or complete closure of its units due to these statewide stay-at-home orders. These are concepts that are typically not designated essential, although you can see that the healthcare space was designated essential, and there were some concepts that were able to do quite well through that. In fitness specifically, a lot of states are continuing to limit capacity, and some have actually instituted new operational requirements that are aimed specifically at the fitness industry. So there's some headwinds in that space. 34% of the gym goers have either canceled or plan to cancel their gym memberships as a result of the pandemic. And a lot of the franchise brands in that space rely on that subscription and membership model. So we know that there's a stressor in that specific area. Gold's Gym is an example of a franchise that actually filed Chapter 11 in May after missing out on a large portion of their membership due payments. So there's impact within personal services, and something like fitness, major impact to COVID. Another portion of that sector, healthcare, includes brands like American Family Care, which is kind of an emergency healthcare franchise, as well as the Joint Chiropractic. They were designated essential businesses and were able to remain open during the crisis. So even within a category like personal services, there were some brands that were designated essential, were able to continue to operate, did really well during the crisis. So there is a bit of variability within personal services. Education is included in that as well. And we're going to take a look in a few slides at a case study for a brand called School of Rock, and talking about how their stay-at-home policies had affected them and how they pivoted during the crisis. So that had a very big impact on a reduction in demand for education services. The average enrollment in that space was down by 67%, and only 18% of the franchisees expected they would survive longer than a year without additional support from either a PPP program or another round of funding. So that's another area of franchising and in the personal services space that is really being impacted by this. 91% of the respondents indicated additional costs incurred for cleaning supplies. And that's something that can really apply across all of these businesses that have a high touch with the consumer. One of the things we did during the crisis is to go out and ask franchisors for what we call the COVID-19 response form, which was a questionnaire that asked, how did COVID impact your brand? What were the changes that you had to make? Did you defer royalties and that kind of thing? Well, one of the questions we asked were, what were the operational and capital expenditures and changes that were going to be needed for your units on a unit level to be able to maintain your brand standards when you reopen via COVID? And I would say that across all franchise units that have an interaction with customers, they're going to have increased costs, maybe not just for cleaning supplies, but for additional positions that have to be created. A standalone cleaner that just goes around and disinfects the unit after use. So these are additional costs that your franchisee borrowers are going to have to incur, and it's important to pay attention to what those are going to be. We estimated about 6% of the total franchise businesses in personal services are still closed as of August 2020. And that's about 1,800 locations. So 25% of the closed businesses there are going to be permanent closures, meaning they're going to stay closed. They're not expecting to open after the COVID crisis subsides. So quite a bit of revenue loss is being experienced in the personal services space. Now, case example, lost revenue in the personal services space. My hair, make sure everyone's paying attention. I don't have a lot of pictures in this presentation. It's a lot of text. But if we just look at the lost revenue in personal services, just for my hair care, just my barber, on the top left is Santo, where I was at the Franchise Investment Conference in March of 2020. And you can see the growth from the top left to the bottom left and to where we are today in September 2020. So my hair care person lost out on 3 cuts of my hair during this period. So substantial lost revenue in the personal services space, as you can see very clearly here in this photo. But seriously, going to the Promise case example, I want to take a look at School of Rock. And again, give you a more concrete example about how these brands are pivoting and adapting to some of the headwinds and issues that we're seeing on kind of a national level. So as I said before, these guys were deemed non-essential. And so School of Rock, just so you guys know, School of Rock is a music education school. What's really cool and unique about these guys is that they have kind of a tiered model. So it's based on age group, it's based on proficiency level. They go beyond just in-person music sessions. They actually have a performance element to it where on a cadence, so 2 or 3 times a year, students in a different regions get together, they form a house band, they practice together. So there's a lot of interaction. There's a lot of kind of community element to this concept, and in-person instruction and playing with the band is a big part of this. So, you know, they saw a huge drop in revenue coming into the crisis, and with all the units locked down, I spoke to their leadership. Every single unit in this system was closed at one point. They could have seen a massive drop in revenue. So what leadership did is within 10 days, they formulated a new plan to develop and introduce a new online program called School of Rock Remote, which was actually an online platform that allowed all the schools to continue to have online lessons and instructors could teach from their homes. So they're able to maintain that one-on-one lesson component of their business, and then over time made provisions for the communal performance and the group performance aspects of their business. So they were able to maintain that online instruction. In the worst days of their pandemic, they were down about 33% on average. Some schools were only down 5%, other schools were down as much as 50%, but they were really able to turn that around using this new platform. So every month since June, based upon this implementation of new technology and a little bit of a shift to their business model, they have seen a steady uptick in revenue every month since then. Whereas today, they're at about 18% of their assisted, or say about, well, it would be 82% levels of their system pre-COVID levels since March. So they're almost back to where they were before the pandemic, and they were seeing growth and increases year over year from March 2020 to 2019. So this is an example of a brand that really shifted quickly, put a new element into their franchise operations, and really benefited from it. The other thing I hinted at before is some of their operational changes. They also created a daily call with leadership. So CEO and executive management gets on a call on a daily basis, and all the franchisees in the system can call in. They can discuss the challenges that are being faced, best practices that are being implemented throughout the system. So this kind of community approach to problem solving really benefited the system and the operation of the units, but also enhanced the supportive culture of the system that they were already driving at, and was a big factor for their success so far. So this is a great example of how COVID forced this brand to make operational and business model changes to adapt to the crisis, and some of the successes that they've seen because of it. Let's talk commercial and residential services. Now, this is a group that has largely outperformed other industries in franchising. These are, kind of B2B services, home cleaning services, those types of things. One of the reasons is that the residential customers are spending much more time in their homes, and are starting home renovation projects. They're cleaning more often, looking to maintain a more healthy environment. Myself, personally, I hired the cleaning authority for the first time ever. I had my first 2 initial cleans, and then they're going to come every 2 weeks. I was spending so much time in my apartment, I started to realize, gosh, it's getting a little bit dirty around here. So I'm a first-time customer. We're off and running. Even in the pandemic, I'm patronizing a new business. So that's a perfect example in my own life where that actually happened. PuroClean is a specific case example where these guys are even on the growth side, so not even on the unit revenue side, but on the growth side and the new unit side are achieving record growth during this period. They signed 31 new franchise agreements since May, and they're opening 21 new franchise locations across the country since January. So whether it's increased business from someone like myself, or maybe someone that has lost their job or is maybe reevaluating whether they want to work from home, looking for a new job, they're looking for perhaps a new business in franchising, a lot of opportunity has been seen there from a franchise development perspective. Another concept that you guys might have heard of, Fast Signs, does a lot of B2B business, and you can understand it and realize why their business is up year over year. We spoke with their CEO, Catherine Monson, and she's reported revenue increases of 20 to 30% over 2019, as she's seen a massive increase in demand for signage and other products that businesses might use to adjust to the coronavirus. So whether that's signage, it's circles on the floor, new uniforms, whatever it might be, they're seeing a huge increase in business in the commercial services space. And as well, it's shown in the closure rate. So from March to August, this group had the lowest closure rate of all the concepts and industries that we looked at 1.4%. So they're doing much better compared to some of the other industries and sectors in franchising. So looking at the regional and the state level impact, we summarized a little bit of this, but I just want to go in just a little bit more detail. And I provided a couple charts that we're not going to spend too much time on, but the information's in there for you if you want to look at where the state closure rates and success rates relatively were in the study that we did. So the top states with the COVID impact were, again, as we said, in the Mid-Atlantic and the West Coast region, so New York, New Jersey, Pennsylvania, California, and Washington. The key impact here is that they're going to have a much more longer timeline to reach stability and recovery in the pandemic, and these are the states and regions as well that had the highest rates of franchise business closures. One of the states that is not included in this region that we are seeing to be severely impacted by the pandemic is going to be Nevada. Now, this makes sense when you think about the disruption in business travel and obviously leisure travel. That's starting to pick up a little bit. Business travel is pretty much still dead right now. And all of us, of course, some of us may have gone to lender conferences or franchisor conferences. They love to have them in Las Vegas. We're anticipating still a 10% business closure rate in Nevada. So that's a state that's going to be disproportionately affected, we think, relative to the states around it. 10 least impacted states are in your Midwest and Western regions. So Utah, Iowa, Nebraska, these types of states are the ones that are less impacted than the rest of the country. So how would you use this information? So we were just shooting data at me. What does this mean? What we do with lenders is we help them understand the brand footprint by looking at current unit counts, where they are on a state level, and then projected openings by state to analyze their relative exposure to COVID as well as where they fit across a lender's footprint. So this is something we were already kind of doing for lenders that work with us, is to map franchisor opportunity and growth against their footprint, right? Because we don't want to deal with franchise brands and spend time with biz dev when they're not projecting growth in our region. But this also has implications where we can overlay the footprint of a franchise brand and where they have their units against impact of COVID and the footprint of the institution that we're working with as well. So that's a way to look at impact data by state and franchisor footprint and growth to kind of understand what brands are more likely to be impacted negatively by COVID. Again, these are some of the charts that I promised you here that just looks at where the concentration is. So it's just a visual representation of the states that we just talked about. I put the numbers and the information here up on the screen. If you're doing any kind of a credit report or review and you want to look at this information, that is available for you. The report as well is going to be sent out, like I said, so that information is going to be there. This just looks at the top most impacted and least impacted states, and you can see the regionality of the impact of COVID and how it might impact where you guys are lending throughout the country. All right, so we talked about the numbers, we talked about the surveys and what we've seen. What are our key takeaways? What can we take away from this that's important, and how is the landscape being changed? First off, in franchise credit. So we're seeing major shifts in the credit landscape for both lenders and franchisors. There are a couple different reasons for this. Some of the lenders out there that we work with found themselves with high concentrations in some of these industries that we just talked about that were disproportionately affected, right? So exposure in lodging, exposure in sit-down restaurants in some of these sectors. So with this exposure, it resulted in two things for these banks. One was a pullback on lending into some of these specific industries. So like I said, lodging and sit down are the obvious examples, but there are other pockets of concepts that maybe were overexposed with their specific partners. So they're looking for new relationships as those lenders have pulled back. As well, banks are taking a much sharper focus on the business model and how that's being affected by COVID. And we walk through some of those exercises of, okay, how does a food brand do business with the customer? How might they be affected by COVID? How have they adjusted their business model? So, but banks are focusing much more sharply on that. And as well, the second thing that has resulted in is a tightening of the credit quality requirements from both a borrower and a deal perspective, right? So banks are much less likely to take on deals in emerging brands. And we didn't talk too much on this call about emerging concepts, but FranData looks at an emerging brand as any franchise that has less than 5 years of operation and 5 or 50 units. So 5 years of operation and 50 franchise units in the US. Anything below that is an emerging brand. Anything above that we call mature. So these banks are much less likely to take on deals in these emerging concepts, and they're much less likely to take on deals for startups and single unit owners. So that's one of the major effects that we're seeing on the franchise credit from a lender perspective. What this has done for franchisors is created underserved pockets of franchisee borrowers, as well as franchisors that are now, as I said, needing to establish new direct relationships with banks. Specifically, what we've seen is in the investment size of under 250K. So anything that's in 250K and under is severely challenged right now. The first bullet point there we've always had to deal with, right? Why underwrite 250K when you can underwrite 750K? That's always been a problem for the smaller investment sizes. But it's more acute now, I think, when a lender is really saying, well, hey, there's a lot of uncertainty out there in the world. Why am I going to spend all this time and all this effort and deal with credit and do everything else just to deploy 200K worth of capital when I can do the same amount of work and deploy 750K or more? So that's always been happening in this space, but it's even more acute now. Banks are also asking for much larger injection amounts and injection sizes on smaller deals. So, a 200K or 150K deal, banks or partners are asking for 30%, 40% injection, really to get more skin in the game from the franchisee. We have so much uncertainty of what's happening in the economy, with a business model, with a borrower, that we're starting to hedge, banks are starting to hedge and protect themselves with larger injection amounts to get more skin in the game from the borrower, especially at this lower investment size. So that has been a challenge for these groups. There's a major opportunity, we think, for banks that can get comfortable with brands at this initial investment size and can meet with leadership, have conversations about where they're growing, what their motivations are, to realize some efficiencies in that process, in the underwriting process and in the biz dev process, to be able to get comfortable and to see really substantial deal flow from some of these concepts. Brands themselves are looking for new partners like never before. We're going to talk a little bit more in detail about how some of their brands saw their lending partners drop the ball on PPP loans and how that has affected things. Other banks, as we said, have had their partners, they've pulled back because of concentration issues. So it may not have been something where the bank dropped the ball. They're just saying from the credit position from leadership that, hey, we need to pull back. We have a concentration in food. We need to pull back. We got to throw money at non-food this year. I'm sorry, we've got great relationships, but we're just not able to do banking to that brand at the same level. So there's a lot of shifting happening on a relationship level just due to concentration issues that certain banks are having concerns about. So, where are the opportunities for lenders? Talked a little bit about these already. So brands have suddenly found themselves looking for new partners. PPP had an impact, right? And some banks did a better job than others. Franchisors had bad experiences with some of these PPP loans lenders, and they're looking for new partners. The key point here is that some of these guys, franchisors, are established concepts with top-tier credit, top-tier fund scores that you wouldn't necessarily think would be worth your time to actually go after and approach. But what we've seen is, combined with the PPP loans, banks dropping the ball on those relationships, and with sector and industry pullbacks from some of these banks, we're seeing a lot of top-tier brands that are looking for new concepts and not necessarily to be a comprehensive national solution. And we'll talk about that in a little bit. For the banks that have executed on PPP loans, what we're hearing from those folks is that they're starting to see the benefits right now, where opportunities are opening up with these existing relationships or new relationships that kind of came to them in a crisis. They performed for them. Those relationships were greatly strengthened, and September was a huge month for banks in the 7A program. So that's what we're hearing is new relationships have been strengthened. Loans are really starting to kick up. September was a big month. And for those banks that have strong relationships, they're expecting to have a really strong quarter in Q4 and going forward into Q1 2021. How to take advantage of the opportunities is to have clearly defined credit boxes. So a bank that's got a clearly defined credit box is going to be in a much better position to effectively evaluate the opportunities that are going to be coming to them in franchising. You're going to know where you are, where your credit box is, and you're going to be able to enable your BDOs with a clear direction for what industries and brands are actually going to be bankable within the institution. A big issue in the first 4, 5, 6 months of this crisis were that credit teams are still trying to figure out, okay, how are we going to play in franchising now? Most of them had legacy portfolios, so we have to deal with the portfolio management side of things, which meant loan deferments, which meant making sure that the royalties from the franchisors were deferred, which meant PPP financing. But now they're looking forward and focusing on, okay, where can we do business in franchising going forward? And being able to translate that message effectively to BDOs is critical, so essential to make sure that these folks can continue to do their job and make sure that the pipeline of deal flow is continuing into the bank. The banks that can understand the implication of these changes and the long run effects are going to be able to drive internal confidence among stakeholders. That's incredibly important, from bank management and the board down to a chief credit officer, down to the underwriting team and across the biz dev folks, everyone being aligned in your franchise plan and in the strategy for your franchise lending vertical is going to help you build deeper relationships and quicker relationships with franchisor management. So knowing that that a brand has been accepted and vetted by credit, we have a box of where we want to, deals that we want to do from a deal size, from a borrower credit perspective, from a footprint perspective, and we're able to arm our BDOs with that strategy, it's going to be much more easy for those institutions to be able to develop these types of relationships with franchisors and get the deal flow directly from the brand. And that's one of the ways that you can build your biz dev pipeline. And we're going to talk about that again in a few slides at the end of the presentation. Now, I hinted at this a little bit before. Typically, when we talk about, and I talk to lenders about direct relationships with franchisors, they think they need to be a comprehensive national lender to have a program relationship with a franchisor. But that's not the case. You don't have to be a national solution. Look at the footprint of the brand. And I talked about that a little bit when we looked at how do we use the COVID-19 state information. But again, just looking at the footprint of the brand, where do they currently have units? Where are they projecting new unit growth in the next year? If there's a brand that's projecting growth in your footprint that you can get comfortable with from a credit perspective, having a conversation with franchisor leadership is absolutely worth your time. Even if you're a smaller bank, even if you don't have a comprehensive national program, franchisors would love to have a one-size-fits-all solution for their franchisees, but that is not the reality of how most of these brands operate. They have multiple lenders for different deal sizes, for different levels of credit, for different uses of capital, whether that's a new unit creation, whether that is for refresh or remodel, whether it's for an acquisition, as well as for different regions of the country. So yes, franchisors want to have a one-size-fits-all bank relationship, but the reality is it's just not possible for a lot of concepts. So there is room for you guys out there to drive relationships and direct deal flow with the franchisors. And these franchisor executives know that, and they're cultivating relationships with multiple lenders. So definitely pick up the phone and give it a shot. We're going to talk to you about how you actually reach decision makers at franchisors. There's resources available for you on Franchise Registry. But that top down, and we're going to talk about top down, that relationship with franchisors is super important. There's a lot of opportunity there, and don't think that you can't get a call or a meeting with those folks just because you're not a big national lender. Further, there are opportunities within these brands that are not just about new unit growth. I talked about transfer activity, and that's something that's reported out on and that we have information on. That looks at the units that are sold from one franchisee to another. And these can be attractive, even in brands that may have a lower franchise credit score, our fund score, and may even have a lower initial investment size where you tend to think, $150K initial investment, that's not a brand that I want to look at. But take a second look on transfer activity. The resales and the remodels, these deals typically involve stronger multi-unit buyers, and they've got larger loan amounts because they're typically calculated at a multiple of earnings. So that can be a very attractive deal with a strong buyer and a large deal size. So even, as I said, even in a low initial investment size brand, it might not be attractive for new unit lending, but may be very attractive for you guys for resale activity or even remodels and refreshes, depending upon if they have a strong ecosystem of multi-unit owners. So that's another place to look at opportunity in terms of looking at the data that we have available for you and how to kind of size the opportunity in the market for new growth and franchising. Transparency. I wanted to take some time to talk about this issue because this is something that we've been hearing kind of bubbling up from franchisors, the legal community, lender service providers, folks that deal with both lenders and the franchise industry as well. That transparency is going to be a huge issue for those that are evaluating the franchise industry over the next 16 to 18 months. What COVID has done is thrown kind of a wrench into the reporting aspect of franchising, and some franchisors are starting to provide and roll in updated inter-year financials that are showing the effects of the pandemic on their unit. So typically, a brand's going to disclose their public information, their franchise performance information, the unit information on a yearly basis. We've seen brands come in with a 6-month amendment that are showing the updated financials for 2020, which from a transparency perspective is fantastic because most of the time we're not going to get 2020 year-end performance information until Q1 2021. So a lot of brands are stepping forward and saying, here, we want to be transparent. Here's the information. It might be that we have reduced revenues year over year, but it's really not that bad and we're coming back. Typically the story of a brand that's trying to be transparent. What's troubling is that other concepts have actually decided to remove the financial information from the disclosures altogether. And that's something that we've heard being seen from bankers, from franchisor development folks as a major, major issue, and it's something that we discourage. So we're encouraging brands to be as transparent as possible, warning them that there's going to be a major chilling effect if they start to show up with no unit economic information and no franchisor financial information in the public space. It's going to be much more difficult for banks to get comfortable with these franchises that are not being transparent. So that's something to pay attention to in all the deals that you look at, conversations that you have with franchisors. Ask about that transparency piece. Ask about if they have performance information from franchise units or company-owned units, and are they willing to share that information with lenders, even if it's in a confidential direct disclosure. That's an important conversation to have with a franchisor or with a brand on behalf of a deal that you might be doing with one of their franchisees. I haven't checked questions yet, so I'm just going to go over here and see if we have any QA. Looks like no questions. So that's great. The final piece of the presentation today, I wanted to just take a quick review of business development and franchising, how it's being done right now, what are the two major approaches, and how can FranData enable you as a bank to power your business development and outreach to franchisors. When we talk about biz dev and franchising, we look at it from two perspectives. We look at the approach to the brand, and we look at whether it's a top-down approach or bottom-up. And this talks about how we reach decision makers at the franchisor level, or how are we reaching franchisees and multi-unit owners on the ground level. And that's the real difference between top-down and bottom-up. Top down, that's your direct relationship with franchisors. Some of these brands have really, really strong actors and operators in key roles at the franchise level. So that might be a chief development officer, a VP of franchise development, director of real estate. These are the types of titles that you want to be looking for. These brands are actively driving financing and recruiting on the management level. A great example of this is Crystal Keene. She's the director of franchising at Goddard School. Super hands-on, organized professional from the franchisee side to the lending side. You know, has a top-tier fund score, has a bank credit report on franchise registry, really does everything to facilitate financing for their franchisees. So when you're reaching out and getting a relationship with someone like Crystal, you're defining your comfort level with the brand, where you're willing to lend, and by what parameters. And given all these factors to be equal, your bank is willing to lend X amount of dollars to this specific brand. You're getting deal flow directly from the brand, from franchisor, from franchisee, and other intermediaries that may work with the concept. So this is a really great alternative to be able to sourcing deals outside of traditional channels like you might use brokers or something like that. What's great about having a relationship with us is that FranData can advise on the best points of contact for this franchise. So who are the decision makers that you need to reach out to, and where's their contact information? We have that, as well as current initiatives like we talked about through this. Is it a refranchising effort? Is the brand selling new units to their franchisees? Is it remodel and refresh? Is it a reacquisition or resale? All that information we have through our relationships with franchisors. So there's a lot of way that we can advise your outreach on the franchisor level to these brands. The other advantage of the top-down relationship are these multi-franchise organizations, right? So think about Focus Brands or a STG Development Group, Yum Brands, these types of concepts that own multiple brands within them. There's a tremendous opportunity for cross-pollination of relationships, both on the franchisor and the franchisee level. So once we're in with one brand, we're able to get relationships with leadership and perhaps cross-pollinate into other concepts. This is also an opportunity for an increased comfort level with an emerging brand if it is owned by an experienced franchise operator. So we talked about those emerging brands, right? Under 5 years, 50 units. Most of the time, that's a hands-off situation for lenders. They want to see more development in the franchisor and more established units and experience with that brand. There are other concepts out there, emerging brands, that are actually owned by these multi-franchise organizations. And an example I've given on all my webinars, and if you've seen me talk, you've heard this already, is a brand called the Red Collection. And what the Red Collection is an upscale, upmarket version of Red Roof Inn. So that's a great example of a concept that, yes, is emerging, yes, is new, but has all the experience and the weight and the backing of an experienced company like Red Roof Inn behind them. So that's a situation where a bank may be able to get more comfortable with an emerging brand. An example of these multi-franchise organizations, Yoga 6, they're owned by a group that operates Cycle Bar, AKT Fitness, and has a ton of experience in building value in emerging brands. So that's an example of one right there with an emerging concept that does have quite a bit of backing behind it in a multi-franchise organization. To wrap it up, bottom-up targeting, as you may imagine, targets franchisees within a system. So this is a targeting approach that says, let's look at the single unit or the multi-unit owners that we want to reach out to and try to attack them. Some of these franchisors don't take an active role in franchise financing on the management level. UPS Store is an example. They have tons of transparency. They have a bank credit report, great fund report, just like the example we just went through with Goddard School, but they do not have an active relationship with banks. So the best way to get to these folks is to target direct to the franchisees and be recommended up through the system by its members and by successful loans that you've made to franchisees within that system. Franchise lenders can access Frandata's franchisee contact list database, and that's information that we have that contains mailing addresses, phone numbers, email addresses, other information that's really valuable for franchise units and its owners. But how do you most effectively take advantage of this information? Who are we targeting? Is question number one. Are we targeting single unit owners or are we targeting multi-unit franchisees? We can build specific lists based on relevant parameters that are important to you, like location, we talked about that, state, municipality, and city, sector and industry, specific brands, as well as the number of units owned. So if you just want to target single unit owners, you can do that. If you just want to target multi-unit owners, you can do that. And we can look here on the next slides exactly how that's done and what are the kind of motivations behind both of those. If we're targeting single unit operators, that typically is a fertile ground for identifying owners that are looking to purchase their next units and become multi-unit owners, right? They're looking to go from 1 unit to 2 to 5 and start to grow. In terms of the approach, single unit owners that we found are much more likely to be actively running their businesses, right? They're much more likely to be answering the phones, opening the mail at these locations. So the traditional ways of doing outbounds with mailers and kind of cold calling are much more effective for this target group because single unit owners, like I said, much more like a small business owner, are actively running their business and in the space. When we're looking at multi-unit owners, looking at perhaps the 2 to 5 unit locations, that's a group that is often looking to grow as an operator to open more units within the system and the brand, go up to 10, 20 plus units, so lots of growth here. Often these folks are either have already aged out of SBA or are kind of close, so they're moving more into the conventional side of the business. This group is really appropriate for the transfers, so like we said about the sales and the purchases, re-imaging and the remodels and the refreshes, purchasing their own real estate, so 504 loans as well as any other products that you might offer from a bank level. So estate planning, wealth management, cash management, these types of things are also typically a fertile ground for those services in the multi-unit owner product line. The wrinkle here is that typically with multi-unit owners, further investigation is really needed to identify who the decision maker is among operators that hold multiple locations. So if you were to pull a list of owners that own 10 units or more, you're going to get location names, you're going to get telephone numbers, but typically as a multi-unit operator owns more and more units, they are farther and farther removed from the operation of those units. So there may be more research that'll have to be done to identify chief financial officer or a director or a manager or something like that who's the actual decision maker at some of these multi-unit owner locations. And that's follow-on research that we do in the form of multi-unit playbooks and profiles of these owners. So there are other resources that are available for banks out there that really want to hone in and target these high-value multi-unit owners and franchisees. All right, that is everything that I wanted to share with you guys today. I have one question in the Q&A box. Looks like that was an aborted question. John, if you do have a question, go ahead and put that in. Okay. John's looking for the recording. There will be a recording for everyone. Yes, Nate Greenberg has a comment to remind the group that franchisors have been reminded that direct bank relationships are important to those who had previously relied primarily on referral sources and intermediaries. That is actually a really good point by Nate, who's someone that operates in that space extensively. So that is really, really important. Cultivating those relationships with banks directly is something that is at top of mind for franchisors right now. It's much more difficult for them to operate in the referral space. So that is Nate identifying another opportunity that we're seeing on the franchisor side for you lenders to go out there and really attack and call those franchisors and get out there, because you don't know how much opportunity there really is. There are franchisors out there that really have a lot of need and are waiting to get your calls. So think about that. Reach out to us for assistance on how to reach those franchisors and their motivations. John's doing hurricane cleanup. Good luck, John. All the best to you guys out there. All right, looks like those are all the questions here. We are going to be sending out a copy of the presentation to everyone, so you'll have that. My contact information is on the screen. I'm available by phone, by email. Please reach out and give me a call if you have any questions on this, any of the products that we talked about, ways that we can help give lift to your franchise credit or discovery program with lenders. We're certainly here to help. And thank you, everyone, for taking the time with me today.